Hi friends, Namaskar Mitro. This is Srinivasan Anand. I am dealing with the PNB scam. This is part 2 in my video series. Now let us first understand what is fraud. It can have a legal connotation and a legal explanation, but we are more concerned from it from an accounting and auditing perspective. A fraud is an intentional act. Is committed by one or more individuals. They may be employees, management, and even third parties. It involves the use of deception, and it is about obtaining an illegal or unjust advantage at the expense of others. Now, from an accounting or auditing perspective, frauds are of two types: fraudulent financial reporting, and the second one is misappropriation of assets. Now, fraudulent financial reporting is intentional misstatement or falsification of accounts, of omission of amounts or disclosures, or misclassification. Like, for instance, in the case of a bank, the good loan, what is shown as good loan, is actually an NPA or a non performing asset. So banks can dress up their balance sheet, show their position better than what it actually is by not classifying NPAs as NPAs, by showing them as good loans. Now, how this impacts a bank's financial position, how it impacts its performance. If suppose a bank has given a loan of 100 and it has turned NPA, and it is not giving any recoveries, and let us say there is an interest of 10 on it, and that 10 also is not recovered, so total outstanding balance is 110. If bank classifies this as a good loan, one, it is able to book that 10 rupees on this 100 interest on this loan, even though it has not been realized. It has booked it on due basis or accrual basis. And secondly, it would be required to create a provision for non-recovery of this 100. It could be anything between, let's say, a part of the amount to the full amount. So an NPA means a double whammy for the bank. Firstly, the income from it cannot be booked unless it is realized or recovered. And secondly, bank will have to create a provision for the irrecoverable amount, set aside profits from other paying loans. So one, it doesn't contribute to the kitty, and second, it takes away from the kitty, from the contributing loans, from the contributing others loans contributing income. It takes away a part for provision to provide for these. So it is a double whammy. So to escape this double whammy, a bank may very well classify a non-performing asset as a performing loan, and there are many tricks they do for this. They kind of restructure it, evergreen it, and so many ways they do, so many tricks they do to show it as performing asset, and they postpone the recognition or facing the fact that it is an NPA. And this is a very one of the areas where fraudulent financial reporting can take place. So you see, it directly impacts the truth of the accounts straight away. The key in fraudulent financial reporting is it will always be material. It will be always be material in the context of the accounts, significant in the context of the accounts. There is no reason for doing the small little amounts of fraudulent financial reporting. It serves no purpose. It will be big, and it will always be with the blessings of the higher up. It cannot happen at the level of an employee. It always is a management fraud, not an employee fraud. So the fraudulent financial reporting is what affects the truth and fairness of accounts in a direct manner. Then we come to the other category of frauds, which is misappropriation of assets. Misappropriation of assets is usually for small immaterial amounts, because the motive behind misappropriation of assets is not to show the accounts, present a better picture of the accounts than what the position actually is. It is not to any way to manipulate the accounts. It is the fraudster is just involved in interested in filling up his pocket. So it may not always be material. How it falsifies the account? How does a misappropriation of asset falsifies the account? Like you are showing 1 crore rupees cash in hand in the balance sheet, and that 1 crore rupees is actually non-existent because it has been embezzled away, but you think it still exists, and you are showing it in the balance sheet. So in this sense, balance sheet has been falsified. Now this may not always be material. Suppose you are 1,000 crore entity, a 1 crore cash balance non-existent, it will not always impair your financial position, or it may not impair the truth and fairness of your accounts. So those fraudulent financial reporting are the ones which directly impact the accounts, and they are more on the radar of the statutory auditor or the external auditor, rather than the misappropriation of assets, which is essentially an employee fraud, and which normally management puts in place internal controls to check it. This LC is in a sense a theft of assets only. You may think 11,580 crores is a very big amount, but yes, in absolute sense it is. But if you look at the context, that Punjab National Bank has shown 4,19,000 crores as loans, outstanding loans in its balance sheet, and the non fund based facilities like letter of credit, letter of guarantee, these come to something like 3,58,000 crores, where the funds have not immediately gone, but in case if customer defaults, bank will be called upon to pay. So in the context of 7,77,000 crores, what is 11,580 crores in that sense? It may not impact the truth and fairness of the accounts. So this is something that one must bear in mind, that between fraudulent financial reporting and misappropriation of assets, a statutory auditor's antenna is more tuned to fraudulent financial reporting and perhaps less towards misappropriation of assets. Because there is a very good reason. In modern practice, the first line of defense is always the internal controls put in place by management. Management, which is primarily responsible for prevention and detection of fraud, and management does accept its responsibility publicly through a director's responsibility statement in the annual report. Then comes, in the context of banks, we have what is called the concurrent audit or the internal audit. Concurrent audit is about checking a transaction the moment it is the shortly after it is carried out, or at least the very next day. So the time gap between a transaction happening and a transaction being checked is very less, and if any deviation happens, it can be corrected immediately. Concurrent audit is substantive checking, not just test checking. And the statutory audit or the external audit in contrast is a test check exercise. The statutory auditor is the external auditor, also known as the independent auditor. His report or his opinion on truth and fairness appears in the annual report along with the annual accounts and along with the director's report, and this report appears with the caption independent auditor's report, and he gives his opinion with the words accounts do give a true and fair view. The concurrent auditor is his report is not on the opinion, is opinion on accounts does not form part of the annual report, and he is basically for management's internal purpose. It's basically the internal audit is a component of the internal control systems and procedures that are put in place by management to ensure that the frauds are prevented, and if not prevented, at least they are detected quickly after they occur. So the concurrent audit is the second line of defense, and only the last line of defense is the statutory auditor, and from him you can expect the least towards detection of frauds, particularly the misappropriation of assets kind of fraud. We will elaborate on these aspects in the next video. Thank you, friends.